everyone to the first of the kind of topic-based sessions of this Invest in Vermont series. This one is local investing: what to know and how to start, and is intended kind of as as the title suggests, as something of an intro to get you thinking about if you're interested in investing your dollars locally, how to do it, and what things you should be aware of as you do so. So to start, we'll do a quick round of introductions with the presenters. I'm Matt Kropp. I'm the Executive Director of the Vermont Employee Ownership Center, and today I'm wearing my hat of the Chair of the Vermont Solidarity Investing Club. And I am I've been interested in personally local investment for a number of years, both kind of with retirement vehicles and on local entrepreneurship and other things like that. So this is a topic that's near and dear to my heart. And Janice, would you like to introduce yourself next?
Sure. Thanks so much for having me. I'm Janice St. Ange with the Flexible Capital Fund. We're an impact investment fund that provides near equity financing or royalty-based financing to companies in Vermont's food system, forestry, and clean technology market sectors. We've been around for about 10 years now and starting to do some equity and convertible debt investing as well. I'm also co-founder of the Vermont Women's Investors Network, which is part of a broader Northern New England Women's Investors Network.
Hi, Louisa Shibley, co-founder of Milk Money Vermont, which is Vermont's equity crowdfunding platform that allows all Vermonters to invest in Vermont businesses. And I'm also co-founder of the Vermont Women's Investor Network with Janice. Glad to be here.
Great. So quick overview of our agenda for this evening. So we'll start with a little discussion kind of the why invest local. Why do this versus other things you could do with your money. A review of some of the key things to know about local investing. And then we'll get into a little discussion of the ways to invest local, covering things like investing in intermediaries, the role that peer groups can play, and what are some considerations around how to do direct investment in local companies. And then we'll end with a little Q&A and discussion. So both, the panelists will have a chance to ask each other a few questions, and we'll also be looking at the Q&A function on the webinar. So if you do have any questions that you'd like us to address, please put those in, and at the end we'll kind of run through those and try to get to as many as we can. So with that, we'll get into the content here. So to start, this is I figure this is a good way to start is to get into a little comparison, right? What are some of the considerations to think about when you're comparing conventional investing and local investing? And look, conventional investing is in many ways easier, simpler. There are systems built up to make it pretty seamless to do that. So a few kind of key comparisons here. One is with conventional investing tends to be, and again, this is not universal, but I'm talking sort of in generalities, investing in public markets, right? Highly liquid, easy to see sort of how stocks and bonds and other things and index funds of those stocks and bonds are doing. Local investing, you're oftentimes looking at a smaller scale, and it's mostly private investment. So not only is it something where it might be a little bit harder to find, right? And less liquid because there's no public markets. But it's something where you have different rules around who can invest and how they can invest, and we'll get into those a little bit later. A second point of comparison is around diversification. Like modern, if you've been investing, kind of modern portfolio theory really points to the importance of diversifying assets in terms of performance and risk. And the public markets make that pretty easy, right? The kind of classic thing in the last probably a couple of decades has been the idea of set it and forget it with index funds. You put some money in index fund, it buys the whole stock market, and you're well diversified and can see kind of steady returns. And for the conventional wisdom is oftentimes that's going to perform better than trying to sort of do more stock picking because of the power of the diversification. Local investing diversification is more tricky, right? Both inherently because you're looking at a specific geographic area, and also just in terms of there aren't as many things that have that broad diversification of like an index fund. So there's more risk concentration potentially. A third piece is the question of retirement vehicles, right? For a lot of people, really the primary point that they invest is through tax preference retirement funds like 401ks or IRAs and other things like that, right? The government incentivizes us to put money into those vehicles, and the vast majority of them are really aimed at, again, kind of public securities, public markets, that sort of thing. It's very easy. Odds are if you work in a workplace that has one of these vehicles, it's going to point you in that direction. Whereas it is possible, and we'll talk a little bit more about that, to use those sorts of retirement vehicles to invest local, right? Self-directed IRAs, solo 401ks, and there's some other vehicles that allow for this. But it definitely requires a little, more setup and more intentionality than the kind of default setting of conventional investing. And the final point of comparison, I'd say, is what considerations are kind of possible in your decision-making process, right? So on the conventional side, it's pretty much purely financial considerations, and especially so if you're talking about retirement plans where there's kind of a strong fiduciary duty on the part of the custodian of your 401k or IRA to say, it has to be financial considerations. There's some marginal additional possibilities for expressing different values with your money through things like investing in ESG, kind of socially responsible funds and that sort of thing. But it's limited in that you're still looking at the same sorts of companies. You're just maybe filtering them by how diverse is the board, or do they have certain environmental practices and things like that. But it's kind of playing in the same sandbox. Whereas with local investing, and this is going to feed into where we're going next, but there's really more possibilities, I think, to pursue multiple bottom lines and multiple sets of priorities that go beyond purely financial, although financial is vitally important. And we're talking about investing, not granting, right? So I've started this presentation off with a little kind of overview of some of the challenges or some of the compared to conventional investing. So let's get into the why you would do this, and invite both Janice and Louisa to chime in on this one about their thoughts. But I figured I'd start it off by just kind of talking about these three elements, right? Impact, right? So when you invest local, the impact of the money that you're putting into something is visible and can be significant. And if you think about, again, these default settings of your 401k money just automatically goes in public markets, other savings just kind of will tend to go in that direction. I think systematically you see the result is that the things that have access to public markets are, in some ways, you can think of them as almost overcapitalized. And the flip side of that is that smaller businesses with the things that that bind our community and provide jobs to our neighbors tend to have a harder time accessing capital. And so the impact of smaller amounts of money coming in and helping offset that can actually be quite significant. The second piece of here is information, right? So when dealing with public markets, pretty much everyone has the same access to information, or hopefully close to it. And if you don't, there's lots of regulations around that. But when you live in a particular community or a particular place, there's unique knowledge of local conditions and knowledge of individuals that can inform your risk assessment and your decision making in a variety of unique ways. And this can be obviously a double-edged sword in some ways in terms of trust that might be misplaced or other things like that. But it gives you sort of the ability to potentially recognize opportunities that might not be so visible to other people elsewhere. And then the third thing is influence. And this is kind of I think a really interesting element that differentiates local investment from kind of conventional and traditional investment. And it's that not only can you have a high impact with your dollars and actually see the impact where you are, but there are also other ways that you can have meaningful influence on the performance of the company you're investing in, right? And I think the classic example of that is even looking at when Ben and Jerry's back many years ago did their DPO, and they would have the local shareholders come out to support the opening of their new scoop shop, right? Those people had a literal vested interest in the success of the business and became advocates for it. And similarly, I think there's a lot of opportunities for you to think about local investment is going beyond just the sort of financial return to, is this building something that I want to participate in and support, and what else can I bring to the table that goes beyond just the financials? So Janice or Louisa, do either of you want to share some of your thoughts on the why here?
I think you covered it all. I mean, I also like, in addition to that, I just look at it, the businesses in our communities they build sort of the foundation and the fabric. And so, investing in your local companies and businesses is investing in your own communities. And it's where we go, we shop, we meet people. So I think it's important for the wealth of our communities. So, but you added most of it, my little 2 cents.
And I guess the only other thing I would add is I just saw a recent statistic, something to the tune of for every dollar you invest locally, 66 cents of that stays in the community and recirculates, and it just it expands from there. So keeping those dollars locally, supporting the business owners and their staff, and especially when they're the ones providing you food, putting clothing on your back, etc. Is can be satisfying and rewarding, so the only other thing I would say is, and it can be fun. Investing local can be fun.
All right, so kind of moving on from the why to starting to get into a little bit of the how here. Louisa, do you want to talk a little bit about this kind of question of accreditation and other considerations? Who can invest?
Yeah. So I'm just going to start off with a little bit of a history. I mean, in 1933, the Securities Act of 1933, after the Great Depression, the SEC basically created the definition of an accredited investor. And that was to help basically protect investors who are inexperienced so that they wouldn't lose their money. And the definition ended up being that it was largely about your net worth. So it was defined as someone who had $200,000 in income, or $300,000 if you're joint, for the last 2 years, or you had a net worth of $1 million, not including your home, or you were a general partner, executive officer, director for a company that was issuing the security. So this was really in connection with direct investments, so not with publicly traded stocks. This was just with direct investments. And actually, Matt, if you can flip to the next slide. Oh no, sorry, I'm going to talk about you can go back in August of 2020, last year, they actually amended it so that they would include more people, because I mean, to limit the people who could make these direct investments based on your financial wealth is certainly silly, because that was basically saying that only people who had wealth were smart enough to make these decisions. So they did broaden it a little bit more. And now there are different measures that include professional knowledge, your experience, and certifications, in addition to the existing ones, which were, the ones that I just mentioned. It does expand also a little bit the list of entities that can invest, which is a good thing, because it just broadens the number of investors that local companies can access. And Matt, why don't you speak a little bit to the new certifications, because I know that you've looked into doing that.
Yeah, and this is something that if anyone else is interested in this, I've been actually considering the idea of creating a little study group following this session, because I'm considering pursuing it myself. But essentially, what they did was create a additional sort of list of certifications that you could essentially study for and take an exam for, that then allow you to be considered an accredited investor. Now, 2 of the 3 certifications basically require you to be an employee of an existing kind of financial company and be sort of sponsored by your employer. So those are not super accessible, but there's one that doesn't, and I think it's supposed to be something like a 3-hour test. So I think it kind of allows for some level of a little bit more of a meritocratic rather than simply a wealth-based access to the sorts of investments that you can only access or more easily access as an accredited investor versus non-accredited investor. So there's certainly happy to sort of share more, discuss more about that at the end if there's interest, or certainly follow up afterwards.
Yeah, and so it also expanded it to employees who are knowledgeable employees of a private fund. So anybody who works for a private fund who's not licensed is now also considered an accredited investor. So it's real. It was a huge step forward, actually, to basically to broaden the definition of the accredited investor. Matt, if you can go to the next slide. So then, of course, it brings up, well, what's a non-accredited investor? A non-accredited investor is basically anyone over the age of 18. And it's an important thing because in 2012, actually, that's incorrect. It's 2012 that's my mistake. Obama passed the Jobs Act, and he basically created regulation crowdfunding, which meant that anyone, no matter what your net worth is, no matter what your profession, no matter what your certification, you have the right to invest in the company. And it set up the guidelines for regulation crowdfunding, regulation CF. But it took several years for the government to actually set up like how that was going to happen. And you see that now today in websites like WeFunder or NextSeed or Local Stake. But in the beginning, it was up to the states if they wanted to create it. So in Vermont, we had what was called the Vermont Small Business Offering Exemption, which is actually what Ben & Jerry's used in the example that Matt gave. So they filed with the Department of Financial Regulation a Vermont Small Business Offering, which meant that only Vermont residents, i.e. you have a driver's license and you live here, could be investing in their Ben & Jerry's. And of course, a couple of years afterwards, they raised $750,000 that way. They built the Waterbury plant. And then, of course, several years later, they went public. And so everybody who had bought shares, I think the shares were like $120 something. It's on their list on their website, obviously made money because they then got the publicly traded shares. It definitely took some time, but Vermont updated it in 2016. And so we co-founded Milk Money as a platform that would allow for non-accredited investors, for anyone in Vermont, to invest in a Vermont business. I think we had 8 campaigns in total. We raised over $300,000 for companies. And it's sort of been, a rocky road. I think it was maybe a little bit premature for, everyday Vermonters, because there was this learning curve of being accredited and non-accredited, and also sort of the whole concept. We're really into buy local, but, it's another step to actually invest local. So now there are definitely some great platforms like WeFunder, Local Stake, NextSeed, as I mentioned. There's also, I think many Vermonters know iFund Women, which I brought to Vermont a couple years ago now to help just female entrepreneurs. But anyway, the non-accredited thing really opened it wide open, in particular for small businesses, because it allowed them to access not just accredited investors, but actually their own customer base. And a big piece of this is that actually companies are allowed to solicit. So which means that they can be on the internet, they can advertise, they could be on TV, they could be anywhere they want to be to let you know that they are raising money. So not only is it great for their marketing, but also they're letting people know, and they could get potential investors, could be anybody.
And one other thing I'll share just on this question of non-accredited investors is that, so the most kind of like obvious and easy to find sorts of deals are the ones that can kind of come through those publicly advertised crowdfunding programs. And there are a few other things that in the law that do allow for non-accredited investors to participate in private offerings. So I think regulation 506B, which is one form of offering, allows for up to 35 non-accredited investors to invest in offerings. And then there's something called kind of under Vermont's law, that's kind of if it's a small company, it's only getting from folks in Vermont and fewer than 25 people in a 12-month period invest, kind of the de minimis offering exemption. That can be another thing. In those cases, though, and we'll get into more about deal flow a little bit later on, it's not something that you can simply, company can simply sort of raise the flag and say, hey, we're raising money. There needs to be kind of pre-existing relationships, and it's more of a sort of kind of the friends family type, classic friends and family type network raise versus what this kind of thing allows for, which is the truly going out to the public type thing.
The one thing with the 506B is that the onus is on the issuer, so it's on the company to prove that somebody is an accredited investor. So it hasn't been very popular because of that. Whereas all the others, it's just up to the accredited investor to self-certify that they are accredited. So there's a little bit of, it hasn't really caught on as well yet, but it's there, and would be great if more businesses would use it.
Great. So moving on. So Janice is going to share a graphic that was too big to fit in the slides. So she'll screen share and then I'll pop back on, talking about different forms of investment in the frame of this kind of capital continuum. So Janice, take it away.
All right, let me see. Let me also see if I can get it so it's a little bit bigger, because it's pretty much an eye chart here. So trying to remember how I did that last time.
I think that looks, yeah,
Is
that's
it
from my
big
perspective.
enough? Can everybody see it? Okay, great. All right. So this capital continuum is really focused on investment structures used in direct investment in private companies. And I guess I wanted to start with the fact that we need all kinds of capital and that no one type of money is better than another. And it's important to keep in mind that when you're investing, to tailor the investment structure to fit the company's stage of growth, the scale they want to grow to, and the use of the capital. So for example, you wouldn't use an equity investment structure to finance equipment or a building when debt could be less and a less expensive source of capital. So this continuum looks at the risk profile of an investment instrument from an investor's perspective. So debt on the left-hand side is essentially loaning money and hopefully getting repaid principal and interest on a set schedule over a finite period of time. Debt's self-liquidating and it's usually paid from the cash flow of the business. And lenders who use debt, they take on a lien like hard assets, including equipment and real estate and inventory. And they may also ask the entrepreneur to personally guarantee the loan. So as you might imagine, debt that is less risky because the lender typically has a second or a third source of repayment beyond a company's cash flow is going to have a lower reward threshold. So lower risk, lower return, and lower cost of capital for the entrepreneur. So equity, which is on the other side of the continuum, is considered highest risk. Investing using an equity instrument means you as an investor have an ownership position in the company with certain voting and decision-making rights. Your investment gets repaid typically when the company sells on a larger investment round or goes public. So the risk here is that the company may never sell, or worse, goes out of business, and you have no way to get your money back. You don't have collateral, you don't have a personal guarantee, and lenders have priority in liquidation of the company. So you're betting on the management team to execute on their plan. So then this being the highest risk, it follows that equity is expected to have the highest reward and therefore be the highest cost of capital for a company. An angel investor in a traditional market, for example, is going to be looking for 3 to 5 times their money back, venture capital, 10 times their money. So having talked about the two extremes on the continuum, there's investment structures that are higher risk and reward than debt and lower risk and reward than equity. And I'll just mention 2 other forms, including convertible debt and royalty or revenue-based financing. So convertible debt is an instrument like a loan from an early round private investor, like an angel or VC. And these folks are usually high net worth individuals who start as private loans with the expectation that at some point later down the road, maybe a year or 2, that debt can convert into equity ownership in the company. And because repayment, including accrued interest, is pushed down the road, this is riskier than traditional debt and therefore requires upside, like a discount on the price of the equity when it converts. So the other instrument I wanted to talk about is royalty or revenue-based financing. And that's based on a company selling a piece of gross revenue instead of selling ownership. Hence, it's often called near equity. In exchange for a loan, the company gives the investor a percentage of sales until the investor has received back principal plus additional interest negotiated with the investor. So this is the primary investment instrument that we at the Flexible Capital Fund use. It allows for the flexibility of equity without dilution of ownership for the entrepreneur. It's riskier for the investor as repayment can fluctuate based on a company's revenue stream, and therefore the reward is higher than a traditional term loan that has a fixed principal and interest payment. Revenue-based financing as growth capital, in my mind, is a good alternative to equity when there's no stated exit strategy and maybe the entrepreneur doesn't want to dilute ownership. Now, I should note that sometimes an entrepreneur may need more than one kind of capital: debt to finance equipment, which can be used as collateral, equity to fuel growth, or revenue-based financing when a company needs fuel, just not rocket fuel, to grow, but doesn't want to give up ownership or isn't growing fast enough for an angel investor. So an example of this kind of approach would be one of the first investments that the Flexible Capital Fund made back in 2011 was with Vermont Smoke and Cure. They were a company that was growing and wanted to move from their location in Barre behind an old gas station to a 20,000 square foot facility in Heinsberg. They were raising $5 million, and they used 7 different kinds of capital to make that expansion happen. They had equity investors, they had bank debt for the hard assets, they had subordinated debt from the Vermont Community Loan Fund to help support some of the other working capital, they had landlord financing for the fit up, they had state funding through the Community Development Block Grant Program, which lent to the town of Heinsberg, who in turn gave them a low interest loan. And then finally, we closed the round with subordinated debt and a royalty financing kicker from the Flex Fund. So with that, I'm going to leave it there. And if anybody is interested in having a copy of this eye chart, I'm happy to send it to you. Feel free to email me. On to you, Matt.
Great. Thank you, Janice. That's I think a very, very solid overview and framework for thinking about how different forms of capital can kind of fit together. It's all not one or two types of things. But so I think you were going to take this one as well, or
Yes.
thinking about investing as a team sport.
Yep. So I guess that's the one thing that I have found over the last 10 years of investing, that it really is a team sport. I would recommend not going it alone. You don't have to go it alone. Really encourage folks, if you want to get engaged in investing locally, do have other investors join you and make sure they're in alignment with your own values and are interested in sharing their skills and expertise with you. The other thing is I would view the entrepreneurs as part of the team and vet them appropriately, as well as build a long-term relationship, because once you write that check, it's like being in a marriage. It takes a lot of work to get out of it. Investing with others who don't necessarily look like you brings diversity of perspective and expertise and can mitigate your risk. So I really have found over the years, again, having other perspectives beyond my own when I'm looking at an opportunity or a deal, and especially if from people's different perspectives that don't look like me, has been very valuable. I would say doing this as a group or in participation with another lender or investor like us makes due diligence easier and faster, and it can spread it across multiple people. Expanding your network can give you access to better investment opportunities. So when we talk about deal flow, having other investors that you are networked with, that are in alignment with, can help you get easier access to deal flow. And I think the other piece of this is it ensures there's follow-on capital for the entrepreneurs that you invest in, because inevitably they will need more capital. I think the other thing is investing with others can help you take an integrated capital approach. So the example I gave earlier of Vermont Smoke and Cure, those were 7 different funders, investors, lenders, and we all knew each other. We all engaged to make sure that we were in alignment with each other's different kinds of capital. So it can help you take an integrated capital approach. And then I guess the last thing I would say is, if you take investing, the approach that investing is a team sport, then it can help stakeholders, which include the entrepreneurs, the investors, the lenders, the employees, see that everyone is important and has their role to play in the success of the business. It's not just the investor's money, it's not just the entrepreneur's idea, it's all of the stakeholders engaged to make this team be successful.
Great. So we're gonna now go from this kind of more talking about the why and some of those details to kind of like to how to do it. What are some approaches to getting your feet wet, and kind of, finding the others and finding deals to invest in. So to start, we'll have Janice talk a little bit about the approach of investing through intermediaries, and certainly this is one approach that it's something that was my first thing when I first set up my self-directed IRA. The first thing I did was a small investment in a CDFI, community development financial institution note that I was aware of, that was doing work that I was supportive of and excited about. And so it was an easy way to kind of get going without having to go too deep to begin with. So Janice, you want to talk a little bit about getting your feet wet?
Sure. Thanks again. You're seeing me 3 times in a row here. So I want to just talk about why funds and intermediaries, I'm going to use the terms interchangeably because a fund and an intermediary are essentially similar, similar vehicles. I think the first thing is funds, investing in a fund like the Flexible Capital Fund or the Vermont Community Loan Fund helps you pool your capital across a portfolio of companies. So instead of having a one-off investment in 1 or 2 or 3 companies, you could spread your dollars across 15, 20, 30 companies, reducing your risk. You can invest in or alongside funds as a participant in a deal, and often with lower dollar thresholds than in a traditional investment. So I'll give you an example. At the Flexible Capital Fund, we have a maximum dollar amount that we'll invest in any one company. If a company needs more than what we can invest in that round, we'll use our network to find a values aligned investor or 2 to make up the difference. And so we do this through a participation agreement that investor can purchase a part of the note that we have in that particular company. We recently did this with one of our companies who was seeking $1 million in revenue-based financing. We did 400,000, and we brought in 3 other investors, one from New Hampshire, one from Vermont, and one from Maine to make up the difference. So it allows you to come in alongside. You don't have to be the lead on a deal. So participation is also a way to get engaged. Often funds can be themed in alignment with what you value. So if you are looking for funds that support women or that support social justice or what have you, or are focused on clean technology, a lot of opportunities to invest in intermediaries and funds that are themed in alignment with your values. Oftentimes, I would also say that funds or intermediaries have different sources of funding in addition to your investment that can add value and bring more capital to businesses and mitigate the risk. So, for example, Matt had mentioned the community development financial institutions. That's part of being part of the U.S. Treasury program. So we are also a CDFI. And in addition to equity investment that we raise from our members, we have access to this program through the U.S. Treasury that gives us additional dollars for investment, gives us money for loan loss reserves and technical assistance for our companies, all of which help mitigate the risk for our investors and for our businesses. Community development financial institutions, again, I'll mention that because they are one of the primary ways in which you can get your feet wet. And I'll tell you who else is a CDFI here in Vermont. They are private institutions that are dedicated to delivering responsible lending to help low income, low wealth, and other disadvantaged people and communities join the economic mainstream. So that's kind of the mission of the CDFI fund. Intermediaries can also be for profit, they can be nonprofit, and they can be philanthropic, like the Vermont Community Foundation. And I think this is a really important point, that intermediaries and funds can do the hard work of finding deal flow for you, doing due diligence, negotiating the deals, and then managing the investments once the deal is closed, which honestly is often the hardest part. In the example I used earlier, where we had 3 participants, once the deal was closed, the Flexible Capital Fund was the one managing the relationship with the borrower. They pay us one revenue check, and we in turn cut checks to our participants on a monthly basis. We do all the follow-up with collections, payments, financial information, et cetera. So it makes it easy. So let's talk about some examples in Vermont and the region of intermediaries where you could get your feet wet. Well, first, I would mention the Vermont Community Loan Fund. They are both a community fund and a CDFI, and you don't have to be a high net worth individual to get engaged with them. You can start with as little as $250 with their social investment graduating account. And they have a focus areas such as food, farms and forest fund, the Next Generation Fund, which is focused on early childhood education and affordable housing programs. We at the Flexible Capital Fund, well, we don't have an offering available right now to invest, and our hope is in the next year we will be able to take on investment from accredited investors. So we're another example of down the road that might be an opportunity to invest. Fresh Tracks Capital is a venture capital fund investing in high growth companies. They've raised 5 funds and typically take investment from accredited investors. I would be remiss if I didn't mention credit unions like the Vermont State Employees Credit Union and the Credit Union of Vermont are open to all types of investors and are great examples of investing local with a low threshold of entry. So when you open a savings account or money market, you're investing your dollars in a local intermediary. That in turn lends to businesses in your community. And I guess, Matt, you had mentioned we're not talking about grants as investments, but I will make the point, I think, that foundations like the Vermont Community Foundation and their donor advised funds can be considered investments because your philanthropic gifts in a community foundation are in turn invested in your community, either as a grant or in the case of the Vermont Community Foundation, could also be invested in a private company that's in alignment with their mission. And we have an example of where the Vermont Community Foundation did come in as a participant to invest in a for-profit business with the Flexible Capital Fund. I guess the only other thing I would mention is there are examples of nationally themed intermediaries with small minimum investment thresholds like C-Note, which is a national platform to invest dollars that in turn support the CDFIs like the Community Loan Fund and the Flex Fund and Community Capital of Vermont. There's Coastal Enterprises in Maine, which is again a CDFI that does invest and lend in all 3 New England states, including Vermont, and they're a regional fund with varying programs focused on whether it's farm and forest, manufacturing, renewable energy. And then lastly, I'll mention RSF Social Finance, which while it's based in California, is a organization that lends and grants dollars nationwide and has a presence here in Vermont. They're an impact lender and philanthropic organization that has the Women's Capital Collaborative, as well as programs that are focused on food systems and the environment. So these are just some examples, some ways in which you can get your feet wet if you're not ready to go full-blown investment directly into a business. I'll leave it at that.
Thank you, Janice. So then I'll talk a little bit here about peer groups, which I feel like is somewhere in between directly investing in companies and doing that kind of like pure intermediary thing, right? And this is kind of where the team sport thing happens. And you can see a picture of a meeting of the investment club that I'm part of. So I kind of break this into two categories, right? One is more of the informal kind of investor networks, right? Where there's no necessarily it's not like you have a shared pot of money that you're all investing together, but you have a community of practice of people who have shared interests, maybe shared priorities or values, right? That might come together to hear pitches, learn about investing together, share some resources and things like that. So there's a few kind of examples, but I'll talk about one first, and then I'll let Louisa and Janice talk about a little bit about the Women's Investor Network. But for online communities, I'm part of one. There's a variety of them. Everything from Facebook groups and just kind of informal networks on social media to to more kind of formal communities of practice. And one that I think is very interesting is specific that I'm part of is specifically focused on retirement investing and doing that kind of self-directed retirement vehicles. It's called the Next Egg, which is it's a project of organization called the Sustainable Economies Law Center, and they basically have an online thing that you pay a small subscription, and then you can both be part of discussions about the particular investments, but also just in general around how do you assess them, how do you figure out if you want to invest in something or not. Are there other people who are interested in it, and what's out there that might be available to other people. And in addition, it also kind of has provided a number of kind of model plan documents if you're wanting to set up a solo 401k or other things like that. So that kind of informal network, or that more informal network where you're kind of sharing knowledge and some kind of resources, but not investing together, is one approach. And then the other is more of the formal thing, and really kind of, I think, investment clubs are the classic example. And so for investment clubs are something that are again kind of a creature of federal securities law, but essentially it's an exemption that says if you have a group that is under 100 people, no one is compensated for making investment decisions. The group makes the decisions together, and no one owns more than 25% of the club. And there's a few other guardrails like that. But as long as you stay within those guardrails, you're not considered an investment company under I think it's the Securities Act of 1940 or something along those lines. And you can, as a group, pool your money and then vote on where to invest. So there's a few of these investment clubs that I'm aware of in Vermont. It's something that there's a lot of examples of them, kind of in especially in the pre-internet era, that would kind of do more kind of publicly traded things. But in terms of local investment, there's the White River Investment Club is one example of this that's active and a part of the state. And then the Vermont Solidarity Investing Club, which I'm the chair of, which focuses specifically on investing in cooperatives. And so basically, we have a group. We've got about 26 members. We meet every two months or so. Has been doing it on Zoom since the pandemic. And then we have an online platform where, after we've vetted and assessed a particular investment that we might want to make, we then have a formal vote that records everyone's opinion on it. And then if that proposal passes, then we send in the money, and everyone and keep track of who's contributed how much, and then we all kind of share in the proceeds of that. So investment clubs can be small, like 5 or 6 people. Again, they can be up to 100, but that can be a way of spreading some of the load, right, in terms of finding deals. I think when you've got a network of a number of people with different connections, any one of them might be the source of finding a company that's looking for that could use some investment, and the club could fit in there nicely. You can have subgroups kind of vet and report back to people, to the rest of the group, around what is this what does this really look like, and is this thing appealing or not? What's the argument for it? What's the argument against it? It's also something, especially for folks with more moderate resources. There's certainly plenty of situations where the minimum investment might be too much for any one person, but if everyone's kind of pooling their resources together, then you can make it, right? So you can aggregate those resources. And then there's some great sort of educational opportunities, especially for new people, where with the example of our club, we have some folks who are very experienced. They have a background in investment and securities and other things like that. And there's other folks for whom this is really, other than maybe a retirement contribution, the first time they've ever thought of themselves as an investor. And so these kinds of communities can really offer opportunities for mentorship, opportunities for kind of really learning, and even some leadership development amongst folks as you kind of rotate officer roles and things like that. So that's a little bit about the investment clubs. But Louisa or Janice, do you want to talk a little bit about the Women's Investor Network and kind of the sort of concept of angel investor groups and
yeah, I mean, I'll talk about the Women's Investor Network. So several years ago, there was sort of a handful of us who started to realize that there were women who were interested in investing in other female-founded businesses. So we sort of loosely kind of got together, and we've come a long way in the last couple of years. And we've now are officially the Vermont Women's Investor Network, and we support all women, trans and gender nonconforming investors in the entrepreneurial ecosystem in Vermont. And our long-term goals include pooling skills, expertise, and capital to fund women and trans entrepreneurs and business owners to create positive environmental and social impact while generating a financial return. We started out with having opportunities for entrepreneurs to come, and we offered them a safe place for female entrepreneurs to share their story and practice their pitch. And if you're interested in that, please join us on Friday to learn more about what it's like for a female founder, the unconscious bias in investing. But we've since morphed a little bit. With Janice at the helm, we now are together with Maine and New Hampshire. So we've created a regional Northern New England Women's Investor Network. And we've largely turned into educational for the moment. With COVID starting last April, we started a series online on Zoom called Her Story, where women would come tell their stories about their transition from traditional investing into impact investing and aligning their investments with their values. And it's been a huge success, a great sharing their stories is so valuable. And we have this opportunity to talk to these women directly and ask questions and basically help others lead the way in terms of how to move their money, because women, as you probably all know, we are under engaged with our financials, but yet we control $20 trillion in wealth. And in the next 10 years, it will bump up to 30 trillion, so more than men. So we have a lot of economic power with our money. And if we can align our investments with, our values, we can do a lot of good. So in addition to the Her Stories, which we now do together with Maine and New Hampshire, we also are starting this year a book club where we'll be reading books about impact investing and investing in general. And we'll be inviting authors to come in and speak to us after we give you a couple months to read the book. We do have a website, nnewin.org.com, and we'll send you all the links actually afterwards. And we welcome you to sign up for the newsletter. We're open to both accredited and non-accredited, so we do educational pieces too. We're also members of the Angel Capital Association, so sometimes we'll do over lunch educational pieces that the ACA offers to its members, webinars that you can participate in. And we also believe in mentorship. So it's open, as I said, to non-accredited investors too, because you don't know when you might become accredited or when the definitions might change. So join and learn along with everybody else of how to make investments. I think that's pretty much it, unless Janice, you have something that I might have forgotten.
Oh, no, you did a great job, Louisa. The only thing I would say is it's nnewin.org.
Oh, right.
Not com. So for folks who want to look us up.
We'll send around links, I think, afterwards.
Great. And so then, Louisa, I think, so that's a good segue to move to talking about individual investment or direct investment.
Yeah. So, I mean, with going back to the accredited investor definition, those accredited investors can make direct investments into companies. But usually the companies, they can't solicit. So they can meet people through their friends and family, through their attorney. Sometimes there was the North Country Angels here, which was a group of angel investors, which I don't think is active right now, but they used to be active. But those kinds of direct investments, so it's all sort of under the radar. It's kind of who you know, which makes it difficult for companies sometimes to find the investors, which is why the non-accredited investor, the equity crowdfunding platforms offers, sort of the democratization of capital, allowing these companies to access more people. So of course, in Vermont now there's Milk Money, and we're hoping to have a deal or two coming down the pike. And nationally, there's WeFunder, so you can go to WeFunder. It's open to anyone, and obviously there have been a couple of Vermont companies on there. So you could be, even though you're in Vermont, you could access a national crowdfunding platform to find Vermont businesses. There's Local Stake based out of Indiana, the same thing. And there's also iFund Women, which helps support female founders. And a lot of women have been quite successful here in Vermont fundraising from them. And the benefit, obviously, as I said earlier, is that you can solicit if you're doing it, doing a raise to non-accredited investors, which not only benefits, you bringing on more investors, but also you're marketing your own business. And you can be, on TV, online, however you want. And I mean, you could also sign up to any of those three, including iFund Women, to their newsletters to learn more about businesses. Or you can filter on any of their websites for Vermont to get information, the national ones to get information.
So I'll throw out one example, and I don't know if Louisa or Janice, if you have kind of maybe a little cases you might want to share about, but one example of kind of a direct investment and finding that as a non-accredited investor, for myself was there's a company down in Western Massachusetts called Real Pickles that makes kind of a variety of pickled products. And they did one of those, they weren't doing a public raise, but they were raising several $100,000 of non-voting preferred stock to kind of fund an expansion. And they're a cooperative. So a member of our investment club kind of heard about the offering, made an introduction. So the club itself ended up making an investment. And this is one of the other things where the kind of peer group and direct investment stuff tends to overlap, is that in addition to the club making an investment, myself and several other members of the club kind of went along in parallel and made investments individually in it as well. Where again, you had sort of the rule where up to 35 non-accredited investors could make an investment in that particular offering. And so that's, I think one of the things, and this is something I see in, say, the Next Egg forums and other things, is that oftentimes when people are like, okay, I want to invest, I want to find companies and do the direct investments, it's oftentimes kind of hard on your own to actually sort of track them down. And that in my mind is one of the real benefits of these more network-based activities, and doing the team sport thing, as Janice framed it, is that as everyone has different networks, and you can kind of compound them. And the other thing is that kind of question of the more sort of like, okay, it can kind of go through existing networks but can't be publicly advertised, has some real kind of, when you're thinking about equity in terms of justice as opposed to equity in terms of investment, some challenges around. And this was something even this morning that was brought up that I think is a really important point, is that people's networks are very different in terms of the resources they have access to. And so the more that you can create these broader networks that are inclusive and bring more people to the table, the less kind of inequality in terms of access to capital for people who have the skills, have the interest, have the drive to do these sorts of things, but might not have won the birth lottery in terms of the wealth of their existing friends and family network. These can be approaches that help start to mitigate those kinds of dynamics. So that's just kind of one example and a few thoughts on this. But Janice, do you have any that you'd want to share?
Sorry, I'll let Louisa go ahead. I mean, all we do is direct investment, but we typically will do it with other investors more along the accredited side. So I'm happy to provide another example, but I think Louisa, why don't you go ahead?
Well, I was going to say, it's not, we didn't outline this in the deck here, but, pre-sales for businesses are a way to raise money. I mean, in my town, a local business here needed to raise money to re-outfit the store. They were looking for $60,000. Community members put down $1,000, you got $1,100. You were allowed to spend 10% of that $1,100. So you made 10% on your money, but she got her $60,000 up front. She was able to, outfit the store. And she knew she had her customer base because they'd already given her the money. There's a company right now based out of Essex that's doing it. It's called Salt and Bubbles Wine and Market. And she's raising money, female founder, same thing, just by this pre-sale notion. She's created a website and everything for it. If you Google Salt and Bubbles Wine Market, you'll see it. And it's a great way to, without a security, to invest in your local business just as a simple pre-sale or a community supported enterprise. It's known as, everybody knows what a CSA is. And a community supported enterprise is an enterprise or business that is collecting the money up front from its customers to pay, to have their customers use it or get the products at a later time, which I think is a great example. And I also wanted to give a milk money example, a shout out to Working Fields, who raised his startup capital through Milk Money. And Working Fields, is an employment agency for second chance hires, and he's just done an amazing job. And Milk Money helped him get off the ground and started. So Google that, Working Fields. Mickey's done an amazing job.
I think I would just add to this idea of directly investing in a company. Um, for all the reasons we talked about, can be rewarding. It can be fun. It can be exciting. It can be a financial return, but it is, I guess, not for the faint of heart in my mind, because once you sign that check and you close on the investment, you're in it for potentially a very long time. And so understanding that you're dealing with entrepreneurs who are people and they have families and they have challenges, so really, I think understanding when you do direct invest in a business, be clear about how much engagement you want to have with that company and what your expectations are in terms of communication with that company ongoing as an investor. Because if there's a disconnect between what you expect from that entrepreneur to provide you with and what they have the capability and or capacity to do, that can create challenges. So this idea of managing a portfolio of companies after you've invested, it's not just the understanding of what to look for when you're investing, but then how are you, what kind of relationship do you have with them after that investment is important to think about.
Yeah, that's a great point, Janice. I think that actually, we can maybe even identify another continuum of, in terms of, liquidity and risk and all of that, right? Where if you're like, okay, I want to put a few $1,000s in, but maybe in a year or two, I'm going to need to pull that out for another purpose. That the intermediary putting something in a CDFI is going to get you the sort of local investment, some of that local investment impact, but a lot more liquidity than putting something into a private company and thinking, oh, maybe in 5 or 10 years there'll be a payday. But it's need to sort of live my life as if that money will never be accessible to me again. And if it does, that's a great bonus, right? So there's this kind of, and then the investment club stuff might be somewhat in between, where it's generally the expectation is, if you're in, it's not liquid, but there might be certain rules for pulling some out, or other members kind of buying out your share if they're under certain circumstances. So I think that's really important to tag. So we're coming up on 6 o'clock, which means we have a little over 15 minutes left. So I think we'll move on to the Q&A and discussion portion to round out this session. So here on the screen, you can see presenter contact info if you want to reach out to any of us to ask further questions or get some resources or other examples and things. So we have a few questions, and certainly invite more folks who've been listening to pose them to seed our discussion. But before we get into them, just Janice or Louisa, any sort of like final thoughts or things that have been brought up by the conversation thus far?
No, I think let's move into Q&A, and maybe more will come up as we do the Q&A. You didn't really talk about co-ops, Matt.
Yeah, so that's one other, I can say here. I'll stop the share now, so it'll be more. You'll see all of us. Yeah, so in terms of the co-ops, that's actually one other, it's personally this thing I'm most interested in investing in, and there's some certain securities law things around that makes it easier to do. So one example of an overlap was with the Oak Street Co-op project recently that we used Milk Money to help promote, which is one of those things that we were able to actually do a public promotion and bring in small dollar investors to buy a building that was owned cooperatively that has a couple of different small food businesses and an apartment in it. So certainly if anyone's interested in that kind of that sort of approach to investing, I'm always happy to have that kind of conversation. But yeah, let's dig into some of the questions here. So one was kind of around and this is sort of a policy thing. So I don't know if Janice or Louisa, if you're aware of this or interested, but any plans for Vermont to expand angel investor tax credit similar to Connecticut, where it allows angel investors who invest at least $25,000 in a Connecticut startup in approved sectors to receive an income tax credit equal to 25% of their investment. Are either of you kind of familiar with that or have any?
We asked a couple years ago, and the answer was no. Maine has a similar thing. I don't know the exact numbers for Maine, but Maine also has that. And as far as I know, Vermont is a no. But I haven't gone back in the last year or so, but it was originally, no.
Cool.
Yeah, unfortunately, I can't add to anything more than what Louisa has to say.
All right. So another question. I was hoping you could explain the regulation CF more and how that works. Like, do you know much about the recent Shaftesbury cider deal that was mentioned at the plenary this morning? So Louisa, I think that would be
I can answer that. I mean, the regulation CF just means that when, I don't know I wasn't on the plenary this morning, so I don't know what was discussed, but in general, when a company wants to raise money and they want to have access to, the crowd, they file with the SEC that they are doing a regulation crowdfunding offering. And that means that they are then allowed to solicit. So I don't know what platform they were using, but they are allowed to market, solicit. Chances are they probably are doing a national reg CF, which would be a WeFunder kind of thing. That, I mean, if any Vermont or anyone across the country can invest in. I mean, that's kind of just top level because I don't know what the reference was.
Yeah, I think so. So they were I think the first Vermont company to raise the maximum that you can raise, which was a little over $1 million. And I think that when thinking about the options, right, there's a lot of benefits to doing kind of from a regulatory perspective to doing intrastate offerings, right, where you're only raising money from in-state investors, because that doesn't trigger a lot of kind of federal securities laws.
Yeah, zero.
Right.
But I mean, if you do a VSBO Vermont one, it's $1 million, and then you can go up to 2 million, but then you have to have audited financials. But I think Reg CF actually recently upped the maximum of $1 million. I think it's a little bit more now. I'm not as up to date on the Reg CF.
Yeah, so I think when thinking about both as an investor, but perhaps also as an entrepreneur, there's the kind of the question of, there are certain benefits to saying, all right, keep it to Vermont, keep it very, very local. But if it's the sort of thing where you're like, oh, well, we think that there's more potentially like significant out of state demand for investing in our company, looking into the Reg CF would be something to explore. Okay, so another question for Louisa. What was the investment fund that was based out of California but also has ties to Vermont?
I think, Janice, you were the one who mentioned it.
Yeah, I mentioned that. That would be RSF Social Finance. They primarily are a lender, and they will lend pretty much anywhere in the U.S. And I know they've done some investments here in Vermont, and they actually have a lender who's based here in Vermont, Casey Johnson. So, but on the flip side, like the Vermont Community Loan Fund, you can invest in their social investment programs, and those dollars will in turn be put to work in companies that are doing the impact investment type of work that they're supporting.
Right, and then we did get a comment on the Reg CF thing, was that in terms of what was changed, the most notable amendment is an increase in the amount eligible companies can raise from 1.07 million to 5 million in a 12-month period at the end of 2020. Okay, so another question was, I'm curious about whether the availability of millions of COVID dollars to businesses affected by COVID has impacted demand for local access to capital. What's your sense of the effect of COVID, the COVID effect on your organization? So I don't know, Janice, do you have thoughts on that?
Sure. I mean, I think for the companies that we were already invested in, what we've seen is those CARES dollars, the PPP loans and the EIDL loans that have come in have been a life source for many of them in terms of keeping people on their staff and helping them pivot. But that doesn't mean that they still don't need additional investment dollars. We had 3 of our companies who were in the middle of a capital raise for equity investment in convertible debt that pretty much stopped when COVID hit. And, they had those COVID dollars, those CARES Act dollars were instrumental in helping keep them around. And now they've all pivoted and are coming back around. but they still need equity investment dollars to move them forward and continue to grow. So I think the CARES dollars were kind of a Band-Aid, so to speak, for many of these companies, but they still need, there's still a need for growth capital from investors in Vermont for many businesses. That's my take.
Yeah, I can say from a particular project perspective, with the Oak Street Cooperative Project, we were raising this kind of member co-op equity. We were originally supposed to close on the deal in March, and we all know what happened in March. So things got things got delayed and ended up closing in June. But I was actually surprised. It was the sort of thing where we collected a decent amount of money, and we basically we were like, oh, are we going to have some people back out as all this uncertainty hits? And we actually didn't, which was totally surprised us, but was encouraging as well. Which might be something just kind of about that particular type of social investor, but certainly like on the it was a surprise. But on the flip side, kind of when with my employee ownership center hat on, where we talk to a lot of business owners thinking about sales of their businesses to their employees as a retirement exit strategy, we definitely saw in the first phase of the pandemic kind of a freeze up of people putting everything on pause as they tried to get oriented. And then towards the end of the year, that freeze up seemed to thaw, and a lot more. We started seeing a lot more activity, particularly activity driven by employees, which at a much higher rate than we normally do. So those are a few of the kind of observations from the crisis that, from my perspective. I don't know. Is there anything else you want to add, Louisa?
No.
All right. So we have one question here about kind of what can be an average ROI on the different types of investments. Janice, since you kind of went through the capital continuum, do you have kind of a sense of that? Obviously, it can be super variable depending on a bunch of things, but.
Yeah, I would just echo that. It can vary depending on the investor's perspective, their mission, their focus, and but generally speaking, for traditional debt, which would be bank debt and maybe subordinated debt, instead of looking at it from an ROI perspective, you look at it, what's the average interest rate that they're going to be charging in banks, anywhere from 4 to 6 to 7%. Sub debt lenders are going to be a little more expensive, between 7, 9, 10%, depending on because they're taking on a little more risk. They're not going to have the kind of collateral that a senior lender like a bank would. Moving up into royalty financing, again, depends on the revenue-based financing structure, the investment, and the whether it's an impact investor or a traditional market investor. For the Flex Fund, we're looking at we're shifting from interest rates to internal rate of return on expectations for our investments, anywhere between 12 to 20%. Depending on the risk reward profile of the company. And then you start getting up into equity investment. Angel investors are going to be 25 to 30% IRR, if not more than that, when you go up into the venture capital world. So that's just kind of an overview. But again, it depends. There are many investors, lenders who are who are willing to lend at 1 or 2% because they're looking at the social and environmental return more than they are the financial return.
Yeah, I would throw out, for kind of the other end of the continuum, those sorts of community development financial institution type of intermediaries. Something like the Cooperative Fund of New England, which is one that I have that I've invested in. I think they pay, it's basically a note that they pay 2% on. And then other things in the kind of co-op space, I think it's oftentimes in the for individual companies, kind of targets in the sort of 3 to 6% range, depending on the type of company and the type of vehicle and that sort of thing, just in my experience.
And I can just say, for the money raises, they were mostly convertible notes, and it was sort of running 5 to 6% on the convertible note.
Yeah, and I guess I was approaching it from the perspective of the intermediary or the organization. What's their rate of return on that investment, as opposed to if you were an investor investing in that fund. So yeah, that's a little bit different perspective.
Mm-hmm.
Yep.
All right, so another interesting question here. When investing directly, debt, royalty, equity in an early stage company, how diligent should you be with, and then with your attorney and in legal review of docs that are generated for the company's offering by their attorney without overburdening a startup's limited resources? What's the balance there in terms of I guess in terms of the diligence without getting almost like over lawyerly?
I would emphasize having a good attorney who understands the private capital markets is really important. And that is not something you skimp on. And if the entrepreneur knows their stuff, they would see the value in having review on both sides, because that's the agreement you're working with when things are good and when things are bad. And when things are bad, you want to make sure you're all understood up front. What happens if you're in default, or what happens if you do X, Y, or Z? So I agree, you don't want to nitpick on things, but you certainly, investing in good legal counsel on both sides is really important, so that you have a good understanding up front of what you're getting yourself into.
Yeah, I think that it's one of those things where once you start wading into the territory that's covered by the various nets of securities laws, it can be easy to step in the wrong place accidentally, and having a good guide can save you a lot, and for a lot of headache and heartache later. So another question here, are there examples in Vermont of this type of local investing that's focused on local governments, such as for community projects or infrastructure, that sort of thing?
I can answer that one. I mean, this website Patronicity is actually set up to do that. And so far, I don't think there have been any projects in Vermont, but there was about a year and a half ago, pre-COVID, some interest in, partnering with Patronicity to try to bring in, I know Michigan has done it, and I think that they've been successful in funding community projects through Patronicity. And the way it works is that, say a community needs to raise $100,000 to put in a sidewalk. You need to get matching grant monies, either from like a community foundation or for the government, and the community needs to raise half of it. So if it was a $100,000 project, the community would have to raise 50,000 to basically prove and show that how much they really want it. And then the monies would be matched. And that's what Patronicity does. I think it's a really interesting model, and I think one that should be explored here in Vermont, but it hasn't been so far.
I remember also seeing a platform, and I honestly can't remember the name of it right now, but that was about essentially sort of making municipal and state bonds a little bit more accessible to sort of retail level investors.
Yeah, there was. I know the site you're talking about, but it's been a couple of years. I'll have to remember that. We're going to send out a list if you're interested of resources. We can send all the links of anything that we talked about. I've been keeping a list. So we'll get the list to you in the next day or so.
All right. So one other question here, and then we're almost at time. But this was one kind of about under investing as a team or club. Have you thought of forming a Vermont-based club of high net worth investors similar to Tiger 21? Would local investors pay a subscription fee for any added value to the club? Tiger 21 charges $30K and requires 10 million investable net worth. So in terms of both that, but more generally in terms of like what's your impression of the kind of that end of the investor spectrum in Vermont, how it's organized or not organized?
Right now, there is no organization. There's no real formal angel network or that kind of organization network set up. I think in many ways, Vermont's kind of small, which is why with the Vermont Women's Investor Network that we sort of partnered with Maine and New Hampshire for a more regional approach to have access to more people and more capital. But it's a really good point. That kind of thing needs to be existed. I don't know that those numbers could be substantiated here with the 10 million, but I think it's an interesting model and certainly exists in other places.
Great. All right, so we're just about at time. So thank you everyone for attending. This has been a fun conversation. Maybe just kind of if there's any final thoughts or advice, or just anything left unsaid. Maybe Janice, do you want to go first?
I would just say there are a lot of resources in state and out of state to help you get started. And I think, you know, there is so much opportunity to invest in local businesses here in the state that, I mean, I think that we've talked a lot about investing in companies that are high growth, but they're the average companies in your own communities who need your help now more than ever, especially with COVID. So I think thinking about ways in which you can invest your dollars, something as simple as shopping locally, that to me is investment, right? So keep your dollars local when you can. And when you want to directly invest in a company, do it as a team. Engage others who know more than you do and learn from them.
Thank you.
I,
Louisa?
I echo everything that Janice said, and I will just add on that, for any women in the call, please come join us at Vermont Win. We'd love to talk to you and, help you learn more and give you more links and resources, and have you engage in our online events where women tell their stories, or our book clubs.
Great. Yeah. And no, this was a good conversation. Appreciate everyone for being here. And yeah, certainly, if you're interested in the investment club stuff or, cooperative investing and other things like that, definitely feel free to reach out. Always happy to have a conversation. And thank you to Vermont Community Foundation for kind of convening this. I think this is an important set of conversations this week that we're having that's hopefully going to have a positive impact on Vermont's economic future. So with that, have a good evening, y'all.
Yep.
Thank
Everybody have a
you.
great evening.
Thank you.